All right, is everybody ready to go?
Yeah.
Well, let's go ahead and get started. We have a full plate. We're going to try to honor the time frame of getting done in 60 to 75 minutes, and that'll probably be a little bit of a test. We've got a few statues to hand out, but let's go ahead and roll. Well, welcome to the January session of the Roundtable. It is our annual award ceremony tonight. We're going to spend some time honoring the efforts of all of the knights and a couple of our guest damsels. You see all the names there on the screen. Kim Butcher is going to try to join us in a few minutes. She was going to be working late tonight, and she's a maternity ward nurse, so she's delivering babies. So if she's late, it's probably for a very good reason. And I'd like to welcome the rest of the panel tonight: Ken Kavulis, Cy Lynch, Ann Manning from Houston, Hugh McManus from sunny California, and myself, Mark Robertson. Let's go ahead and get into the program. You see a couple of email addresses there if you have any follow-up questions. Again, we make the PowerPoint available on our website. You can find it in the Manifest forum, or if you're not a Manifest subscriber, you should be, but if you're not, you can also write to that email address, and we'd be glad to share aspects of the program with anybody who holds up their hand. Here's the agenda for tonight. You'll see that we're going to actually have 5 quick stock selections tonight, but we're going to spend some time just kind of looking back over 2011 and the year preceding it. We've been doing this for nearly 2 years now. We will pick some stocks tonight, but we're also going to hand out a few statues along the way and just have a little bit of fun. Here's our quick reminder to keep the compliance departments all around us happy that everything that we do here tonight is for educational purposes. No investment recommendation whatsoever is intended, and again, there's all the disclaimers. Do your own homework, and we could actually hold some of the stuff we talk about. We always try to remember to mention if we actually hold things. You heard Cy's story of holding Home Depot literally for decades, so we generally try to disclose that. We don't always remember, so keep that in mind that we could actually have more than a passing interest in a company that we're kicking around here in the group. I'll start with just kind of setting the table a little bit for kind of the framework or the atmosphere that we find ourselves in here over the last year or so. What you're looking at here is the green shaded area is one measure of the stock market. We actually are using the value line arithmetic average, as you can see over here on the y-axis, to characterize the stock market. One of the reasons I wanted to share this slide tonight, a couple of reasons. This is what we've basically dealt with over the last year or so. And you can see that it was every bit a roller coaster, peaking in late spring, early summer, taking quite a dive into early autumn. Then we had one of the best months in stock market history in October 2011, and basically ended up the year slightly negative to slightly positive, depending on how you measure it. Again, when we take a look at companies and develop return forecasts for companies, we very much look at things like this low total return forecast from Value Line, and you can see that there's obviously an inverse relationship, and what we mean by that, as stock prices are generally going up, as you can see over here on the left-hand side of the chart, in general, return forecasts are going down. So they're inversely related. That's best typified by the depths of the Great Recession and the fact that we had among the highest forecasted returns in stock market history back in the spring of 2009. And it's a time when it was tough to think about investing in stocks, but again, this is just a reminder of the type of stuff that we've seen over the last 6 or 7 years. Now, specifically with 2011, when we're talking about the stuff that we'll be kicking around here, performance results tonight, I think it's kind of cool to point out how tough the sledding has been. And Morningstar actually shares that amongst the professional mutual fund managers running stock funds, equity funds, only 17% beat the S&P 500 during calendar 2011. And that's as low as it was back about 14 years ago when only 12% beat the S&P 500. As we'll show, more than half of our knights and damsels managed to outperform the market, but as a group, we didn't. We didn't. So as a group in the aggregate portfolio, we came up just a little bit short, but not too bad. But again, just to give us some context, that gives you an idea of what we've been up against for the last year. Also wanted to throw in real quickly just a quick slide. This is one of Cy Lynch's favorites. It's taking what we refer to as the sector radar, using the ETFs put out by Vanguard, using the S&P Standard & Poor's definition of sectors, and these are the sector ETFs. The reason I bring it up tonight is just to show that we've sorted it by par, just like it says there in the long URL. but the sectors with the highest projected returns are technology and financials. And as you'll see, the 5 people selecting stocks tonight shows all of their stocks for the portfolio, for the tracking portfolio, from either technology or the financial sector. Oh, and by the way, that ETF sector radar is available from the homepage as one of the public or published dashboards at Manifest Investing. You can also get there by using the link up at the top of the page. All right, quick reminder of what we're here about. We try to come together, share ideas, and put together a portfolio that we can take care of and achieve a long-term relative return versus the Wilshire 5000, that's the general stock market, of about plus 5%. And as we pick our companies, we would like to see 60 to 70, perhaps even 80% of those selections outperform the general stock market over the long term. And we'd really like to be somewhere in that 70% range. Here's a quick look at our first snapshot of results. We're not quite where we want to be long term. Our all-time return, again, is a couple percent negative as you stack up all the stocks. But for 2011, we actually did pretty well. So for 2011, we get, we'll just make a smiley face. That was okay. And this, a year ago, was like this. The bar was out here behind the sword, behind the Claymore sword, so that we're actually headed in the right direction. On the accuracy a year ago, we were down in the 30% range. So you can see that we've actually improved up into the 50% range. We want to get into that 60, 70, 80% range. So again, we're aimed in the right direction. Again, to give you kind of a bit of context, if you look at the Motley Fool's stock picking exercise known as CAPS, the average investor, the average performance result is down in the range of about 40%. So we really hope to be able to outperform that fairly consistently over the long term. Here's a quick look at the actual selections made in the portfolio, going all the way back to July 2010. And you can see the cost at the time of selection and the current price as of the close of last weekend. And we compare the total return, annualized for any time that's more than a year ago, versus the market return. Again, that's the Wilshire 5000, and we come up with a relative return. So in the case of Lilly, that was a Hugh McManus selection, the first one made in the Roundtable series. It's gone up 13.9%. During a period when the when the Wilshire 5000 has gone up 13.1%. So the
Mark,
relative return. Go ahead.
Can I interrupt for just a second? Mark, we're getting a question about the term accuracy that you're using. Can you define and explain that term just a little bit more?
Yeah, the accuracy is simply has the selection outperformed the general stock market or not? Yes or no? In the case of Lilly, you can see here that the relative return is 0.8%. That means that it has outperformed the Wilshire 5000. So Lilly actually has outperformed. The one right below it, Stryker's, slightly underperformed. So going down the list, you can see from the green and red listings which ones have outperformed, which ones have underperformed. So again, we're trying to create a situation where 60 to 70, even 80% of the time, we're picking these stocks over the long term that outperform the benchmark. Now, there's been one position closed out. You see it in the middle of your screen there. That was Strayer Education back about a year ago when we actually got cold feet on half of the Strayer position. We closed it out, actually at a time when we were 6 percentage points better than the Wilshire 5000. Now, the PowerPoint's available on our website, so I'm not going to spend a whole lot of time here other than to point out that every selection is unique. We're going to be looking at them in a little bit more detail here in a second, especially the ones that have worked out well for the award ceremony. And here are the ones over the last 6 months or so. And you can see there's a whole lot more green there, a whole lot less red, and we're pretty happy. And the damsels are a part of that. Kim and Ann are actually 4 for 4, and we're enjoying their participation. They're helping make us better total portfolio-wise. So you can see here, 51.5% of the selections made to date have outperformed the market, and we're still a little bit less than where we want to be. For a quick look at the portfolio, you can look at the tracking portfolio at any time using that link up at the top. Again, that's a public link. You can come there whether you're a subscriber or not. You can see the portfolio report card there on the left. The portfolio seems to be fairly well positioned with decent projected return stocks of high quality and decent growth. You can see that they've been spread out amongst small, medium, and large companies, the smaller companies being the faster-growing companies, the large being the slower-growing companies, and then there's a nice mix of these real core companies in the middle, the medium-sized companies. From a sector diversification standpoint, even though I think none of us have actually made an effort to consciously look at it, you can see that we are fairly well diversified with a slight concentration in technology and healthcare, and coming out of tonight, we'll have a little bit more interest in financials. So I thought we'd close with just talking a little bit about, again, we haven't closed very many positions at all, in fact, just one. And this notion of a challenge means to take the dashboard for the portfolio, sort it by projected return, and focus in on and basically challenge the companies at the bottom to see if they merit a potential sell. So the companies that have actually worked out the best, TJX and Deere, that's one of Kim Butcher's pick from selections from a couple of months ago, they're actually up quite a bit. Any one of these companies that is shown here is the value of $1,000 invested at the time of selection. So you can see that Ken Kabula's TJX is up 58%, Deere's up almost 40%, and their projected returns are actually down to where they're a little bit below the average stock in the stock market. So we could consider selling them. I don't think that any of us are inclined to think that way right now, because the portfolio has enough return and enough quality, and the growth is also pretty good too. So there's nothing really pushing us. We might take a closer look at companies like Deere and TJX in terms of momentum. We'll take a look at a couple of those charts here in a second. But again, didn't see anything that was compelling or an automatic type challenge for all of us to explore in any great detail. Of course, the ones up at the top are also subject to have they become too good to be true? Research in Motion. I don't remember who picked that one, but it's actually down.
We
I do.
We all remember that one.
I think I remember it too. It's funny how you're the only one with the faulty memory, Mark.
Does anybody out there get the feeling that they were all sitting there waiting to pounce on that one? Anyhow, as Mr.
I thought you were
McMahon,
challenging that one.
I think that was selective memory, Mark.
selective memory. That's good. You guys are all in trouble. I'm taking away your Christmas cards.
That last voice that you all heard was Kim Butcher's. Kim's from Evansville, Indiana, and welcome, Kim. We're glad that you made it from work tonight.
Well, thank you very much.
And she is the proud originator of the Deere idea just 4 months ago, and it's up almost 40%. We'll talk more about that in a few minutes. But one thing that I would point out with Research in Motion, that Hugh McManus pointed out that they apparently fired both chief executive officers within the last day or so. So maybe there's a silver lining in that cloud at Research in Motion. But
there's definitely motion there.
There's certainly motion.
In the wrong direction.
In the wrong direction. All right. We're going to be patient because time can heal most wounds. I'm not going to say all wounds, but as you're all sensing, there is a bit of a wound there. Here's a look at Deere. Here's a look at Deere using StockCharts.com just to kind of throw it on the scale and see if there's any concerns about momentum. And by momentum, we use the Relative Strength Index. And again, it's just something that we've been exploring as a community in a little bit more detail. Anytime the Relative Strength Index gets above 70, it's a condition which can be thought of as overbought. And you see one here. And all we know from that, looking back historically, is that we shouldn't be surprised by either a flat spot or a downward trend in the price following this condition, which Mary Ann Davis calls snow on the mountain. Same thing over here. This was a down or a flat spot. Wouldn't be surprised at all to see it. When it comes to Deere right now, it's not quite up to that 70 threshold, so I wouldn't be too concerned. And from a challenge perspective, if we look at the low total return forecast from Value Line, that's also 10%, so it's not screaming, you need to be concerned about me right now. Anybody
Mark,
else have any comment on that?
Yeah, Mark, I'm getting a couple of personal chats here. Folks, this chart is coming from StockCharts.com. If you look in the upper right-hand corner, you'll see the copyright. And if you want to recreate this chart or a lot of different charts, go to StockCharts.com. There's a tutorial right on the website that'll help you create charts just like this one.
Yeah, now I would encourage people, if you're wrestling with the notion of momentum, and identifying momentum to study the section in the chart school on relative strength index. That's what the RSI stands for. Here's a look at the other company, which has been extremely successful for us, TJX. As you'll see here in a few minutes, it's our best yet. I believe Ken brought that one somewhere right around here, so it's actually done quite well. And that one is actually up to where I would not be surprised to see TJX hit a flat spot in price or even a slight decline in months ahead. So again, depending on how we think of it as knights and damsels, we may be actually having, especially if it trends even further up in price, higher in price, we may be having a discussion on whether it's time to protect our gains in TJX. I don't think any of us regard TJX as the ultimate core holding, so it's somewhere kind of in the gray area. It's a very capable company, no question about it. So, and again, just as a strong second opinion, with a low total return forecast of 9%, probably not a whole lot to be worried about there either. All right, so let's launch into the middle part of our program. We'll get started on stock selections here in a minute. The first award that we're going to hand out, the first statue for 2011, I get to present it because it's the one statue I've achieved so far. That was Walgreen, and I don't think we have to belabor the story where I was pretty high on Walgreens back in August 2010, and I couldn't find anybody else out there other than, I believe, Dan Hornick and a couple others. Not that I keep track of names, but there were a few people that were in favor of it, and Walgreens actually ended up being the top performing stock for the Roundtable for the balance of 2010. What you see listed here is the performance of the top 12 selections for 2011. And of course, the leader at the very top of the pack, and I think it's a fitting tribute to Steve Jobs, Ken Kabula's pick of Apple Computer. It's actually up at a relative return of 27.5% since it was selected. Quite a substantial return over a fairly short period of time. That's about a half a year, but it did edge out Mr. McManus's Aflac. And Kim and I would like to point out that our selections of Deere and Home Away don't have a whole lot of time on the clock here. They're pretty new selections, but they were capable of challenging for the lead by the end of the year. So, and I know some of you are out there sitting there, look, Mark, there's a whole bunch of Robertsons on this list. You made a lot of really good selections, and you're going to find out. Well, who said that? Well, you got to be thinking it, right?
True. Yes, sorry. It's what I was thinking. You're right.
It's not what you were thinking? Oh, okay.
I was thinking that, sure, yeah.
Anyhow, my point is, as you're going to find out in a few minutes, I'm not the all-time leader, and then the reason is because of RIM and some of those other crazy things I've decided to do. But you can see there's some pretty substantial selections there over the last year or so, so congratulations, Mr. Kabula, on clocking in with Apple as the leader towards the end of the year there.
Thank you. The stock that I find the most interesting on this list right now, since I was the one that brought us into pork in the first place, is the fact that one of our Zhongpin picks is actually performing pretty well. Zhongpin has quite a run in the last couple of months, going from the $7-8 range up to about the $12 range now. So Zhongpin might not be dead for us yet, folks.
Pigs can fly.
Pigs can fly, right?
You certainly have.
We're all hopeful.
And there's a couple other interesting selections on there. A few people questioned Cisco Systems, and you can see that he was one of the people who selected it in that $17 price range. So it's one of the top performing selections. So,
Mark, Dan Hornick would like to remind you that while I was choosing Apple, the very best choice in the 2011 choices, that was the same exact month that you were choosing RIM. So he just would like to point that out. Okay.
For some reason I can't get that row to come up on the spreadsheet, so I'm having trouble with that one. Just kidding. I keep track. I pray over it. All right, and now since we've got a couple years under our belt, we'll have our first award of the 2011 Best Selection All Time. And so that includes selections from 2010 and 2011 now, so you can see a few more names filtering in on the chart. There's many more 11s than 10s, which basically underscores the fact that we are doing better lately. But again, Mr. Kavula, you walk away with this one with your selection of TJX companies back in September 2010. So you need to make a little more space on the mantle.
Thank you, thank you, thank you.
And there's some interesting selections on there. I also like to point out, again, Cisco is a 5-time selection here over the 2 years we've been doing this. And you can see that the recent performance of Cisco, and you'll hear us grumble about this several times before the night's over, the recent performance of Microsoft and Bank of America propelled one of us to the top of many leaderboards. It's just incredible. Most of that on Friday last week. You know, one-day wonder. It's a one-day wonder. All right, so TJX is the best selection we've made so far. So Ken, two trophies on the mantle, and we'll press on forward. And then we'll invite Mr. McManus to go to one of his more entertaining selections again, Bank of America.